Drop it.
Welcome back, my passive income investors alike, to what is going on with this virus. What's doing the best? What's doing the worst? Where should you be putting your money? We're going to analyze the different sectors here, and then we're going to listen to some billionaires to see what they personally think and are doing with their money during this coronavirus. But I wanted to start with the utility sector because there has been a perfect storm going on with renewables especially. But let's start with some that I own here. We're talking about Southern Company, which has been on an absolute tear as of recent. We got companies like SRE at all-time highs pretty much. Another one that I personally own is Northland Power. And the perfect storm going on here is the combination of basically anybody dealing with natural energy as the economy is kind of getting really gung-ho about companies moving toward, wind power, solar power, battery power, things like that. And then on the other spectrum, we have this virus that's pushing down the rest of the market, but everyone's flooding their money into utilities because it just seems to be the safest sector during these market conditions. And I mean, look at something like Brookfield Renewable Partners. This stock is an absolute beast right now, being up over 100% from the beginning of 2019. And these were stocks that were dormant for like 5 years where nobody was really paying attention to them. But the problem is if you're listening to me talk about this now, it's a little bit late to be getting into these in my personal opinion. The utility sector used to drive a lot of dividend investors due to the high yields, but those yields are absolutely diminished considering taking a look at something like Northland Power. When I was buying it, I was getting a 5% dividend yield, and as of right now, it's below 4%. Southern Company, another one that I was buying, now is under 4%, whereas I was buying it at a 5% yield. And you do not want to be chasing rallies in the market, in my personal opinion. But if you are a value investor that loves buying individual stocks, this is prime time to be looking at other sectors. So let's start obviously with the ones that are getting hit the most, and these are your leisure companies, the ones where people want to go out, have a good time, maybe vacation on a boat, and there's nothing better to look at than Carnival Cruise. Carnival Cruise is down a whopping 50% pretty much from its all-time highs. It continues to downtrend farther because obviously some of their boats are literally locked up right now dealing with the virus, and it is going to hit them pretty hard, I imagine, on their first quarterly earnings. But for a company like this that has done exceptionally well over the last 5 years, to see it take a dip this far is pretty impressive. I mean, I think throughout this whole year, things are going to be a little bit out of control for certain companies like this. But for day traders and people that are short-term thinkers that are scared, I mean, it's going to be a little volatile for you. But for those long-term perspectives out there looking 3 to 5 years out, I honestly think this is going to blow over. I don't know what the full extent of this virus is going to be. I don't think it's going to become a full-on pandemic, but it's definitely going to resonate in the first quarterly earnings, hopefully dissipating out through the summer. But with Carnival Cruise right now paying out a 5.7% dividend yield, which they may have to lower, variant on obviously how affected their income is, but with a PE of 8.13, my goodness, guys, I am going to keep watching this. I don't like these companies because typically in bad times, if we go out through their history, usually when recessions come around, these are the companies get hit the worst, and Carnival Cruise is nothing of the exception when it dropped, 57, 60% on the 2008 bubble that burst. But I mean, at the same time, I don't own any of these stocks. I mean, I wouldn't mind getting into them at these levels because they're just so bloody attractive. And I mean, the worst case scenario, you're going to see a little bit of a dividend cut in the short term, but I do believe this is going to blow over. Taking a look at another stock like Wynn Resorts with some of their casinos in Macau. This is primarily Las Vegas and Macau-based real estate that deals with casinos, obviously taking another major ding over the last couple weeks here, guys. The dividend yield, not nearly as attractive in my opinion. Are they going to be hit really hard considering they completely shut down Macau? We're probably going to see a ding in those first quarterly books, but we can move beyond the leisure sector to find discounts as well, guys. I mean, look at Boeing, not down nearly as much, but a lot of the airplane companies are being hit by this, obviously with the travel bans, all the other stuff going on. We have our top tier tech companies, things like Apple, Microsoft. You got Nike in here, guys. We got Facebook, and these stocks aren't even dropping that much considering most of their products are being manufactured in China. Now, when it comes to these top tier companies, it's a lot harder to gauge out whether you consider them on discount or not. We will find out on those first quarterly earnings how bad they're being affected, which will hopefully bring the stock down lower to people like myself that want to buy. But the problem with most of these companies is they do not offer discounts for very long. You're always going to be paying a premium no matter what. So any kind of dip they offer, I kind of recommend to start cost averaging in. And the one that I would personally recommend at of all of them is Facebook, because they do not have factories in China. They're not producing or manufacturing products. And in fact, most people are probably spending more time on social media during these scares than any other time. And we also have political uprunners spending like tens of millions of dollars. Look at like Bloomberg on Facebook ads. So I mean, Facebook is poised, I think, to do very well on first quarterly earnings. So any of these dips that we see below the 200, I consider extremely attractive for a top 10 S&P 500 stock. But we can also go to some other sectors, guys. I've been paying really heavily close to the financial sectors, also getting hit pretty hard during these economic times. So I mean, if you're looking for discounts out there, guys, don't go to the utility sector. I mean, fear might push you into the rally of the utilities, but they're getting very priced into their numbers. They're not trading at really deep discounts, considering Wells Fargo trades at an 11 PE with a 4.5% yield, and something like a Southern Company's trading at a 15 PE, Northland Power trading at an 18 PE. This is the time where you're going to figure out exactly what kind of investor you are, and hopefully you're not following the trends. The trends are things you need to catch before they happen, not while they're happening. Now that these top tier companies are seeing one heck of a reverse, this is where you got to open your ears and your eyes up and start allocating money. And even if you don't have a ton of money, no one's saying you need to be throwing tens of thousands of dollars at these stocks. But you know, if you can come up with an extra 500 or 1,000 bucks over the next couple weeks, I really recommend paying attention to some of these top tier companies. Again, guys, just keep in mind, all of this news blows over, and in another 6 to 12 months, maybe a couple years, there's going to be another thing that is going to be negatively affecting the markets. But I still think we are in some incredible times. I still think the markets are going to do very well this year overall. It's just going to be these first quarterly earnings that are going to impact it the most, followed by the year-end earnings that we're probably going to see the biggest hit on, depending on how, you know, most of summer leading into winter and December finalizes. It's going to be really neat to see how this goes. But I want to listen to some billionaires, see what they're doing with their money, and see where things are kind of shifting around on their mindset. But I hope you guys enjoyed this part of the video. Stay cool, stay awesome. Let's get right into this.
As we mentioned earlier, this week's brutal market sell-off has wiped $1.7 trillion in market capitalization from the S&P 500. Joining us right now by phone to try and put this in some perspective is Lee Cooperman. He's Omega Family Office Chairman and CEO. And Lee, we've talked an awful lot about this, the volatility we've seen the last couple of days and the straight down action. Are you a buyer or a seller in the market today?
I'm doing both, but I would say that on balance, I would be a buyer. I think the significance of an event for the market is a function of what the market was discounting when the event occurred. If you go back, I was on with one of your colleagues, Scott Wapner, on February 18th, and I said the market was knocking on the door of euphoria, that there were lots of issues that were being ignored by the market. I've lost a lot of money the last few days, don't get me wrong, because I'm an investor. But I would say that to have a strong opinion about the market today, you have to have a strong opinion about two issues. And one is the coronavirus. Does it get under control in a reasonable time frame? And second, that we don't have a socialist or a communist in the White House. Okay. I have no expertise in the coronavirus other than my confidence that mankind will conquer this problem, and I think it'll be resolved by June. And again, I want to make it very clear, I have no particular expertise in that regard.
Which problem, Lee? The socialist problem or the
coronavirus?
Okay. All right, you don't.
Okay, the socialist problem, we'll have to see.
Might not be conquered by June.
Pressure today was really day one of the accentuated weakness in Carnival, Royal Caribbean, and Norwegian cruise lines. How the heck were those cruise stocks able to stay so high last week after the tragic corona outbreak on Carnival's Diamond Princess, which turns out to be, of course, really maybe the worst thing that's happened in this whole epidemic? I'll say it again. You don't want to be stuck on a cruise ship in the middle of a pandemic. The numbers have to come down. I have no doubt that cruise traffic will eventually make a comeback, but think about it. It took Chipotle, a fantastic company, 18 months to recover from its last big healthcare scare. I mean, the scare was terrible. In December of a couple of years, it took 18 months from when they had it. It was up in Boston, remember? So why should the cruise lines be any different? Give them 18 months, for heaven's sake.
I think probably the first thing viewers want to hear from you are your thoughts on what's happening with the coronavirus, if this is a reason to panic, and if you are worried about this.
Well, I don't know I have any special thoughts beyond the news on the coronavirus. The very first day I bought stocks was March 12th, 1942. And the stocks were down about 2% that day, as it turned out. Unfortunately, I bought in the morning, so when I came home in the evening and my dad told me the execution price, it was down 2%. But if you're buying a business, And that's what stocks are, businesses. In fact, people will be better off if they say, I bought a business today, not a stock today, because that gives you a different perspective on it. Then presumably, if you buy a farm, if you buy an apartment house, if you buy a business, you're going to own it for 10 or 20 or 30 years. And the real question is has the 10-year or 20-year outlook for American businesses changed in the last 24 hours or 48 hours? And you'll notice many of the businesses we own, partially own, American Express, we've owned it for 20 years, Coca-Cola, we've owned it for 40 years. Those are businesses. And you don't buy or sell your business based on today's headlines. And if it gives you a chance to buy something that you like and you can buy it even cheaper, then you're good luck, basically.